All right, welcome back, everybody. So, a friend of mine texted me the other day, and while the poor dude was sitting on jury duty, he started thinking about investing. So, he reached out to me and said, hey, it'd be a good idea if you do a video on the difference between investing in individual securities or investing in funds. And I thought, you know what, that is a good idea, because I've spent too long talking about life insurance and other types of financial planning aspects that I haven't really gone over some of the basics in a while. So without further ado, let's dive into it and go over what the difference is between investing in individual securities and funds. So first, we've got to define what we mean by investing in individual securities or investing in funds. And it's somewhat self-explanatory. If you're buying individual securities, this could be stocks, bonds, or other types of individualized securities on their own. If you're buying those specific slices and that's it. So if you want to buy a share of XYZ company, you're exposed to all the upside and all the downside of just that one company. Now, if on the other hand you decide you want to invest in a fund, you would be buying shares of an investment company, either a mutual fund or an exchange traded fund or ETF, and allowing the manager of that fund to make the specific investment decisions based on their stated goals and objectives. Now, there's some nuance if you're deciding you want to invest in an ETF versus a mutual fund. Now, there's two main styles when it comes to fund investing. You have active investing and passive investing. And to make a long story short, what active investing is you are entrusting a portfolio manager and their investment team to try to pick the winners and avoid the losers. When it comes to passive investing, all you're really doing is entrusting that an index, that can be something like the S&P 500 index or the NASDAQ 100, you're entrusting that broad market will go up or down. And the portfolio manager for a passive fund is not trying to beat the market, they're trying to just be the market, to use a somewhat overly cliched term. Then also, like I mentioned a little earlier, you have mutual funds and exchange traded funds. Now, there are differences between the two of these. One of the biggest ones being that a mutual fund you're buying and selling directly from the investment company, which means they only price once a day at the end of the day. An exchange traded fund, the name gives it away in an ETF, is that it is bought and sold on an exchange. So it prices throughout the day, meaning you could buy or sell it throughout the trading day, and you're going to know the price you're going to get it for. Another difference between mutual funds and ETFs is they tend to distribute either capital gains or dividends differently. And what I mean by that is oftentimes a lot of especially active mutual funds tend to distribute capital gains and dividends in a less tax efficient manner than a lot of ETFs, especially passive index ETFs. But we've talked about it enough. Let's look at a few things here and try to give you a better idea of the difference between investing in individual securities and investing in funds. Now, I'm going to show you some specific funds because it's just going to make it easier if I pick one or two to use as an example. But this in no way is an endorsement that you should invest in these specific funds I'm going to look at with you. So just keep that in mind. So the first thing we're going to look at here is going to be that active mutual fund. And I've gone ahead and just selected a JP Morgan fund here. We'll just go through it. Remember, this is in no way an endorsement to invest in this fund. I'm just using it as an example to try to explain a little bit more how an active investment fund works. So if you go on, this is straight on the JP Morgan website for this fund. So if you go on, it's talking about, net asset value, their year-to-date return, number of funds that are in there, or I should say the amount of money that's invested in the fund. And all this data is to help you decide if this is something that makes sense for you to invest in to reach your goals. Now, all of these funds are designed to meet certain criteria, and they're usually at the very top. So like right here, it says designed to provide high total return primarily through a portfolio of US large cap equity securities. So it's letting you know what the investment objective of the fund is. So if you're somebody who's looking for high growth, you probably don't want to invest in a fund that is value and income oriented, because it's going to be more geared toward dividends than opposed to total return growth that you would be looking for. So just something to keep in mind. But one thing you want to look at, like I mentioned, when it comes to active investing, is you're paying a portfolio manager and their team to try to beat an index, or mimic the index but with less volatility and risk. There's different ways they go about it, but they're trying to do a better job than just investing in the broad market through a passive index fund would allow you to do. So if we look at them, there's a few other data points here you want to look at. If you're paying people to run a fund and you're having to pay their salaries and the amount of money it would cost in order to do good research and all the types of stuff that goes with it, that's going to cost money. So another big difference between active investing and passive is active investing in funds tends to be more expensive. And that tends to be basically expressed in something called the expense ratio. So let's go down here and you can see what the fees are on this portfolio. So their gross expenses are 73 basis points, which you can see here. And just a reminder, 1 basis point is 0.1%. So 10 basis points is 0.1% and 100 basis points is 1%. So you can get the idea. The net expense ratio for this is 69 basis points. So that's not very cheap. You're paying the fund manager that much every year in order to manage the fund. Now, if they're outperforming, hey, that's great. And you are not going to get something for free. But there's a lot of studies out there that a lot of studies that show that even most active managers do not beat their index. So let's look here at their performance of this fund. If we look at it, let's just go quarterly here. So we'll get their 1 year, 3 year, 5 year, and 10 year numbers. So the NAV, remember, that's the net asset value. So that's the value of the assets in the fund. And then they're valuing themselves against the S&P 500 index. So if you look at their 1 year, I mean, they're not beating the index there. Their 3 year, they are. Their 5 year, they are. And their 10 year, they're roughly in line. So the question is, you have to decide, does active or passive make sense for you? And one of the things you want to look at is not just performance, but also the fees and the objectives that fund is trying to do. And everyone's going to be different. So that is what an active fund tends to look like. Now let's go ahead and take a look at what a passive fund would look like. So when it comes to passive funds, I've gone ahead and used one of the classics here, the Vanguard S&P 500 ETF. Now the VU here is the ETF version of their classic Admiral Shares Mutual Fund, which is just the S&P 500 index fund. Now you could see right off the bat some of the data at the top. Remember we talked about expense ratios. That active was about like in the 70s and 60 basis points that you would be paying. For right here, for the passive fund, the expense ratio is 3 basis points. So it is much cheaper to invest passively. And the big difference, like I said before, is that active fund is trying to beat the market by avoiding the losers and picking the winners, while the passive index fund is just trying to be the market. Now, how do they go about doing that? Now, the way they try to do that is by mimicking the benchmark that they're holding themselves to. So for the Vanguard S&P 500 index fund, it's in the name. They're holding themselves to mimic the S&P 500 index. So if you look here at their portfolio composition, the number of stocks in the VU is 506. In the S&P 500 benchmark, it's 503. The median market cap's the same, earnings growth. I mean, they are just trying to replicate it. And the way they're doing that is by market cap, they are trying to just mimic it. So if we look at the composition right here, like the top 10 composition of the Vanguard S&P 500 Index Fund ETF, Apple is 7% of the fund. The S&P 500 is a little over 7% Apple. Then you got Microsoft, 6.22, Amazon, Nvidia, Google, all the way down through those 506 individual holdings that's within the fund. So you're starting to kind of see how a passive fund works in comparison to an active fund. Now, while we got this up, let's go ahead and take a quick look at the portfolio composition in that JP Morgan actively managed fund that we are looking at. So if we look at the top 10 holdings back here in the JP Morgan fund, over 9% is Microsoft. Then, 5.6 is Apple, Alphabet, Google, Amazon, AbbVie. You're starting to see the difference here. And just those top 10 right there is 40.5%. And when you look at the number of holdings inside the JP Morgan fund, remember, the S&P 500 fund had 506. This one has 54. So you can see that they are trying to avoid the losers and make sure they're picking the winners. So how do you decide which one of these approaches is best for you? So if you're somebody that likes to have extreme control over what they are invested in, then probably picking individualized stocks, bonds, really individualized securities is your best bet if that's your number one value, is having total control over what you're invested in. The downside is that you are really having to devote the time and the effort and the energy in order to do the research and the planning in order to build out your own individualized security portfolio. And there's been a lot of research that shows that it's really tough to do that. Even the majority of the professionals out there fail to beat the benchmarks that they're held against. So you want to kind of keep that in mind if you're deciding if you want to do an individualized security approach or more of a fund approach. Now let's go back to active and passive. Now, my biases on the table, I tend to subscribe more to the passive investment approach for most people. Now, I tend to favor passive because for the vast majority of people out there, it's more than good enough. It's a relatively simple approach that can get you the long-term returns that you need as long as you nail in that asset allocation, and you're not having to pay excess fees or really add extra complexity that's just going to give you a headache over the long run to try to manage something like that. You can get a well-diversified portfolio with just a handful of index funds, because if you look at, remember the numbers that are in some of these index funds we talked about before, I mean, that S&P 500 index fund was over 500 individualized stocks. So you're well diversified at that point. Now, if you want to go with a more active approach or have some sort of like combined method between passive versus active, that's totally fine too. You just got to know that you're going to be paying more for active, and you've got to figure out what the objective is for those active funds and try to line them up with your personal objectives as well. And what that means is it's going to also take more time and effort than just taking a simple passive approach. But if that's something that you value and something that you want to try to get, then by all means, do that. You need to do what is best for you in your particular situation. You just need to go into it eyes wide open. So I hope that's helped to break down a little bit the difference between investing in individualized securities and investing in funds, and then the different types of funds you could invest in. So if you have any ideas or things you would like me to talk about in the future, go ahead and drop a comment below or shoot me a note or an email, and I'll add it to the repertoire and we'll move forward from there. And as always, I hope you all have a great day. Take care of yourselves out there, and I'll talk to you next time.